Hi, it's Jim Du. I'm a wealth expert, and today I want to talk about interest rates. And interest rates, if you haven't been sleeping under a rock, you know they've been going up. And that's because inflation spiked and the Federal Reserve started raising rates on the most dramatic, fastest pace they have in decades and decades. And by doing that, rates have gone up at banks, rates have gone up for the ability to get money. And I want to talk about the 8 ways that interest rates affect you as an entrepreneur. Let's dive in. The first thing is cost of new debt. Timing is everything for a new fixed rate loan, and right now, small business loans have been between 10 and 12% interest. That means entrepreneurs qualify for less and pay more in interest compared to 2021 when interest rates were about 4%. Think about that difference, 10 to 12 versus 4. So you're paying a ton more money and you're getting less money, and banks are also getting tighter on how they're lending money. So how does this impact you, the entrepreneur? Well, if you need money and you have to borrow, you're going to pay way more for it, and banks are probably going to give you less. So what should you be thinking? First of all, you want to make sure you understand your cash flow and your sales and your revenues so that you're prepared for the higher interest rate, so you don't end up in a cash crunch. The other thing is, before you borrow money, see if there's any other way you can bootstrap your business so you don't have to take loans from a bank at these interest rates. You might be more successful than you think if you're more creative. So before you ask a bank for money or an investor for money, I always say go sit in a quiet place by yourself and think for an hour or two about all the ways you can run your business and scale it and grow it without taking other people's money. You'll be surprised at what kind of ideas you come up with, and you probably will need less money than you think, because the interest rates right now are very challenging. I would expect they're going to go down here in the future, but for now, you want to be very careful about taking on debt and on loans at these high interest rates. These high interest rates are going to come down. Most experts predict that even by as soon as the end of this year, but certainly by the end of 2024, that interest rates are going to start coming down. And when they do, all of these loans are going to get repriced and be cheaper. So if you're in a variable rate loan that seems very high right now, it might not be as high in a year or two. So you can think about that into your plan, because unless something else happens, that's probably what is going to happen. But don't let that drive your decisions about running and building your business. Because if you build a good business, it's going to make you way more money than a 10 or 12% interest rate on a loan. Again, don't be reckless with the money that you borrow, but don't be so afraid that you don't fund your business if you have a great business idea and a great market to run in. Now let's move on to the next one. Consumer spending. High interest rates typically limit consumer spending. However, considering U.S. consumer spending rose to its highest ever in Q1 of 2023, 14.3 trillion, there are clearly other factors involved. It's actually been amazing how strong the consumer has stood up and kept spending despite higher interest rates, despite inflation. So how does this impact you? Sometimes we think we know what's going to happen economically, but we really don't. We assume higher interest rates means lower consumer spending. And I still think the economy is going to be slowing down the rest of this year. However, don't bank on that. Don't expect that things are going to happen in a way that's going to impact your business. And truly, if you have a great business, no matter what happens with the economy and consumer spending, you can survive. Because if the product or service you offer is so desired by your target audience, then you will survive any kind of economic downturn. You might be wondering, if higher interest rates have not slowed consumer spending, does that mean that interest rates are going to stay higher longer? And the answer is yes, that could happen, because if inflation stays high, and that's really what you want to look at most, the Fed is most worried about inflation. Until inflation gets under control, the Fed is going to keep interest rates high. They may raise another time or two, but they're going to keep them high for a while. So this could go on longer than you think, but I would expect that the economy is going to slow and interest rates are going to come down as inflation continues to moderate. But don't count on that. Build your business and count on you, because that's the one person you can count on, and make sure you're constantly improving your product or service, improving your sales and marketing, improving your financial structure, because that's what's going to drive you through any kind of downturn, because this won't be the last downturn. The markets and the economy go in cycles, and the more you're prepared and the more you continue to hone your business, the more you'll work right through them. And by the way, tough economic times are good for businesses when you have a good business. Why do I say that? Because competitors often fail, and then you have fewer competitors when you come out the other end. Let's talk about the next one. Investor activity. Low interest rates allow for easier investment into risky entrepreneurial ventures. When interest rates rise, investors become more cautious. What does that mean? That means that if you're trying to raise money to fund your venture, it's going to be harder because investors are going to be much more careful because interest rates are higher and they're trying to be cautious. They're not putting money into ventures that are risky as much as they were before. What does this mean to you? This means that you want to make sure that you can always fund your venture without outside money. Because if you're in that position, you will grow in any environment. If you do need money from investors, during this time it becomes more challenging. So how can you be prepared for that? Make sure your message is clean, succinct. Make sure you can show the financial numbers because investors want to see a history of making money and doing well. And the only way you can do that is to run your business efficiently and to maximize not just your revenue, but your margins and your profits. If you can run your company and make money during high interest rates and high inflation, when things get back to normal, investors are going to be very attracted to you because they're going to say, wow, if you could run your business and make money with high interest rates and high inflation, when things get back to normal, you're going to explode. So whether you want investor money or not, it's great to be in a position where they want to give you money. You know, the best time to take investors is when you don't need the money and when they want to give you the money, because then you can negotiate the best terms and give up the least equity to really drive your growth and your scale. Let's move on to the next one. Overall growth. As the cost of leases, equipment, and staff changes based on the cost of credit, interest rates have a direct impact on how fast a business can grow. So this is very true because when you're running a business, when you have inflation, prices go up very quickly. And everything that you're doing for that business, whether it's employees or again leases or materials or supplies, all of that's going to go up pretty dramatically. And that means that your margins get squeezed. And when your margins get squeezed, you have less cash flow to reinvest in the business and also to live a good life and also to invest outside your business. So thinking about those inputs and how you can better manage that, looking for other options, substitutes for certain things that you're spending money on that may save you money during the hard times. And also, how can you actually increase margins and grow revenue rather than just worried about the expenses? But the expenses are going to be a big part of growing your business. And that's going to be a lid that holds you down unless you have the product or service that you can increase pricing on. Let's move to the next one. Variable debt burden. Flexible lines of business credit typically have variable interest rates, so the same amount of debt can have a vastly different overall cost depending on your current rate. So typically you're getting a line of credit, whether it's a business loan or a home equity line of credit. Most of those loans are variable, and as rates go up, those variable rates go up, and that can be a challenge when you need cash. So the first thing is, when you need to draw on those variable lines, make sure that you know what you're using that money for. Don't just pull the money because you're nervous or because you think that you need it for your business. Do you really need it for your business? And if so, what are you going to spend it on? So if you're spending it on, let's say, marketing that you know will increase sales, that will increase revenue and profits, then that can be a good use of the funds. But if you're doing it just because you're spending too much in your business, that's a mistake. These variable rate mortgages and loans can be a big problem if you don't manage them appropriately. You might ask, what are some ways you can manage this appropriately? The first thing is, don't take the money unless you absolutely need it. So pulling on lines of credit unless you absolutely need it is a mistake because you're paying unnecessary interest. However, don't be so scared that you don't pull the money when you need it. Have a game plan about what that money is used for and when you're going to pay it back and how you're going to pay it back. Pulling a line of credit with no idea of what it's going to be used for and no idea when you're going to pay it back is a really huge mistake, because if you get too laden with debt, now you're really going to struggle to grow your business. A couple of things you can think about when it comes to managing these variable rates is look at all your options. So don't just assume because you have your home equity line of credit with one bank that that's your best option. Look to other banks, look to other solutions, look to other ways that you can get money, because there may be rate differentials where you get a better rate from a different bank, and even changing your banking relationship could make sense depending on the interest rates and how badly you need this money. If you don't need the money right now, you might say, well, I really don't need the money, why should I care? If your business is doing well right now, it might be a good time to increase your lines of credit. Because increasing your lines of credit, that needs to be done when you don't need the money. And then when you need the money in the future, you'll be glad that you have it. So think about, if your business is going great, you're making a lot of money, go to these banks and try to increase lines of credit and get lines of credit so the money is there if you ever need it in the future. This next one is critically important, and that's pricing strategies. Changes in interest rates do not have to make or break your business, but they do need to be reflected in your prices. Consider changing them accordingly. When it comes to pricing, often business owners are afraid to raise their prices. But pricing is something that has to go up over time. Inflation, even when it's low, means that all the inputs to your product or service are going to go up gradually over time. But being stuck at one price point makes no sense. So get over the fear of raising prices. I always say, it's good to dip your toe in the water before you go all in. So before you just massively increase prices across the board, test it here and there with your key customers. See if they're willing to spend more money for your product or service. And often you'll be surprised if you provide a good product or service to a niche market that really wants it, you'd be surprised at how much you can raise the prices and still keep the revenues and the profits. Now remember, when you raise prices, often sales and revenue go down. Don't focus on that, focus on your margins, because often less sales, less revenue, but larger profits is a great way to build a business. Too often I see business owners worried about top-line revenue, and they see their friends and they love to brag about top-line revenue. But you know what matters most? How much do you take home in your pocket? How much do you cash flow? Because if you're cash flowing and you have wide margins, banks like you better, you can reinvest and grow your business, and you can build something sustainable and substantial over time. Let's say you raise your prices, and then in a year or two, interest rates go down, and you start to see competitors dropping their prices. What should you do? Should you drop your price? I would say the last thing you should do is drop your price, because it cheapens your brand. It shows that your brand is not worth what you think it's worth. What I would say is a better focus is think about how can I add more value and keep the price the same. Too often the easy thing is to lower prices. And remember, you do not want to have a product or service that competes on price, because when you compete on price, you compete with the Walmarts of the world, and they will crush you on price. You want to compete based on value. And if you say, hey, I increased prices a bunch, and I'm seeing competitors lower their pricing, the first thing you should think of is, how can I add more value to my customer or my consumer or my client to justify the higher price, rather than immediately thinking I just have to lower prices. Because people will pay more for more value. So add more value to your product or service, and that should be something you're always doing, because you always want to think, whether inflation is high or low, you should always be thinking about raising prices in the future and increasing value. Because if you sit on your laurels and you don't increase your value, then your product's going to go stale. It's not like 20, 30, 40 years ago where you could sell the same product over and over for decades at a time. The markets are changing too quickly. Always think about, how do you increase value and how do you charge a premium for your product or service? Let's talk about the next item, international trade. Differences in interest rates between countries can have strange effects on currency value. If your business involves importing goods, keep an eye on your buying power. When it comes to international, you have to worry about currencies. And if your business sells internationally or is manufactured internationally, the currency change could bite you. So you want to be aware of what's going on with currencies and be prepared for those differentials. Currencies now, they move over time. So sometimes the US dollar gets stronger versus the euro, sometimes the euro gets stronger versus the dollar, but sometimes those trends can go on for 5 or 10 years. So the first thing is build into your financial projections what could happen with currencies so that you're not shocked or you have no game plan if your currency gets weak or strong versus an international currency. You also want to take advantage of those times when the currencies work in your favor. So understand your pricing and making sure that you understand how that pricing impacts the people you're working with overseas, whether they're your supplier or whether they're your buyer. So interest rates can have a movement on currencies. It's important if you do international business to always keep your eye on that ball, because currency changes can impact your pricing and your value to your customer. The next thing we should talk about is profitability. Interest rates are just one of the many factors that affect a business profit margin. Take a holistic approach to your business and never let one problem overwhelm your overall strategy. Too often I see entrepreneurs get focused on one thing, inflation or interest rates, or maybe some of the inputs to their product or service. You want to have a holistic approach. You want to look at everything that is involved in taking your product or service to market. And as you look at all those things, you want to still remain focused on sales and marketing, cost to acquire a lead, lifetime value of a customer, so that you can maintain your revenue and your profit margin. The most important thing by far, in my opinion, is the profit margin. Because if you're only focused on revenue growth, you're not going to make any money. And if you have strong profit margins, that's your number one defense to anything that could happen anywhere in the economy, anywhere to your customer or client. Profit margin is one of the best defenses to a change in the economy, to a problem with your customer or your client, or anything a competitor might do. The best companies have healthy profit margins, so that's a shock absorber that you can work through any difficult time. And that's also the way you truly make a lot of money and build a business that others want to invest in and others want to buy. When it comes to profit margins, here are mistakes that I see entrepreneurs make all the time in their business. There's 3 areas where they end up spending too much and squishing their profit margins unnecessarily. So the first is subscriptions and things they're spending money on the P&L, the profit and loss statement. So often entrepreneurs have software or subscriptions that they're not even really using that automatically are coming out of their bank account every month through their business. Spend time and close attention on what you're spending money on and look at every line item on your business credit card, on your business checking account to see where you're spending your money. And I bet you're gonna find some areas that you're spending money that don't give your business much value. The second thing is employees. Employees and your team is probably one of the most critical pieces to your growth and your success. However, often there are employees who are inefficient, who are not actually doing great things for your company. And because you like them or it's such a pain to fire and hire that you just say, that person's good enough. That person probably is doing half of a job. So often I'll see 2 employees that are doing the work that really one employee should do. So making sure you get systems and processes to make your business efficient so you require fewer employees, and to make sure that each employee is maximizing the output for your company. And then the third thing that I see is entrepreneur business owners, they use their business like a piggy bank. So they have all these personal expenses coming out of the business. And because they're doing well, they're feeling like, oh, I deserve this, I deserve that. You want to make sure that you're not using your business for a personal piggy bank, because that is limiting your future and your growth. Remember, your goal is to build a great business with great profit margins, making a lot of money. It's not to have this lifestyle to buy a bunch of stuff and not build true wealth. So focus on your business and make sure that you're not spending money like it's your personal piggy bank. Remember, the way to beat the market is to understand and pay attention to all the changes that are happening. So you want to pay attention to inflation and interest rates and consumer spending, but you don't want to obsess over it, because that's always going to be a roller coaster ride. But you want to be flexible and nimble about how you're running your business. So you want to pay attention to your customers, you want to pay attention to your pricing, you want to pay attention to your profit margins, you want to pay attention to all the costs, you want to pay attention to interest rates if you need to borrow money, or the attractiveness of investors wanting to invest in your business. You want to keep an overall approach that you're focused on moving and maneuvering as things change. Often I see entrepreneurs, they think, once I build this great business, it's gonna run by itself. I'm gonna be off on a beach in Bora Bora, I'm gonna be driving my Lamborghini, I'm gonna have my private jet. It doesn't work like that. You have to pay attention to your business, you have to change with the times, you have to be flexible, and you have to proactively see things coming in the trends and act to make sure you maintain your business, your profit margins, and your customers. Thank you for watching my video. I hope you enjoyed the content. I hope you got some really important points that you can take home and you can actually improve your situation. And I hope you watch my next video.